Hello and welcome to a wonderful world of option trading. I have decided to start doing these series of training because about 10 years ago, when I was trying to understand the world of option stock, and it was really hard to find simple training information to help me learn. I spent thousands of dollars on very expensive courses and to come out confused and not being able to even trade anything. After many years of studying options, stocks, and forex trading, I said, okay, when I have time, I will start creating a few training modules to help people who are the way that I used to be. In other words, is a way to give back to the world. At least I can help someone. I will try to speak as slow as I can and try to be as clear as I can so that I can help you understand how to trade options. And if anything that you don't understand or something that I say doesn't make sense, please uh, uh, send me an email, contact me. I will put my contact information in the comment section of the video, and or you can go to miamistocks.com and send me an email or post your questions in the comment section below, and I'll do my best to answer your question. So we're going to start talking about the wonderful world of option trading. What I want to do is break down the training into different sections because I know sometimes it's hard to absorb a lot of information at one time. So creating small sections of that training will make it easier for you to understand and easier for you to follow. So I'm going to break it down into three series. We will be talking about what are options, and we will find out why trading options and options versus stocks. So we will try to make it as simple as possible. We will break down options first, then we will move to different sections of it. The first three series that I will do is talk about those 3 points. Then I will go back to options and break option down into different sections, into different terms and different ways that you can trade it, different strategies that people are using. At the end, I guarantee you, you should be able to at least understand the concept, and you can go on into learning more about option trading. All right, so let's get started. First of all, we need to know what are options. Okay, basically, option is the contract. It's a contract to buy or to sell 100 shares of an asset. It can be anything. It can be a stock. It can be a commodity. It can be futures. Anything that has a value. You can have a contract to buy that asset. So an option contract usually have 100 shares of a stock. All right, it has 100 shares. So whenever you buy a contract, an option contract, you basically buying 100 share of that asset. When you buy a contract, you buy the right, but you don't have the obligation to really buy or sell that asset. It's an option. You have the option to do that, but you don't really have to do it. The right to buy is called a call option, and the right to sell is a put option. So you will always hear those terms. What is a call? What is a put? Well, the call is the right to buy that asset, which is 100 share of a stock, and a put is the right to sell 100 share of a stock. Let me give you a simple example. Apple share is traded at $200. If you want to buy 100 share of Apple at $200, you will need about $20,000. Most people cannot afford to pay that kind of money to trade Apple stocks. So you can buy an option, and with that option, you have the right to buy or to sell 100 share of stock for a lower price. So that's where the option come into play. Let's talk about those terminologies. The right, not the obligation, set or strike price, certain or expiration date, call options, and put options. First, what is the right, not the obligation? if you buy a call or you buy a put, you can change your mind anytime, at any point before the expiration date. You can cancel that options at any time because as a buyer, you have the right, but you don't have the obligation to really move forward with that contract. Okay, you can cancel that contract at any time before expiration. Then the next one is the set or strike price. Whenever you buy an option, the strike price is fixed in the option contract. For a call option, the buyer has the right to purchase the stock at that strike price up to the expiration date. For put options, the strike price is the price at which the asset of the stock can be sold. So, in other words, when I'm selling you that contract, and when you are buying that contract, we agree on a set price. Let's say that I want to buy Apple share at $190. That's the strike price that I agreed to buy 100 share of that stock. And you agree to sell it to me at $190. That is the set or the strike price. In other words, you have the right as a buyer, but not the obligation, to buy that stock at that price from the moment that you pay for that contract until the expiration date. And this leads us to the expiration date. The expiration date, this is the date when the contract expires. When you buy or sell an option contract, you must agree to an expiration date. As the buyer or seller of an option, you can choose which expiration cycle you would like to invest in. And we'll be talking about those as we move forward. I will show you how you can select your own expiration date because there are predetermined dates, many different dates. So you select what date that you want your contract to expire. That's a choice that you have. Let's talk about call options because we have call and put. A call option is an agreement that gives an investor, which is a buyer, the right but not the obligation to buy a stock or other instrument at a specific price within a specific time period. In other words, you buy the right to call in or buy an asset. You profit on a call option when the asset increases in price. In other words, when you buy a call options, basically in your mind, you believe that the asset or the stock, whatever it is, will gain value, will go up, will increase in value. And if you believe that, so you buy a call. Now, call is the reverse of a put. A put basically is an agreement that gives an investor the right but not the obligation to sell a stock, a bond, commodity, or any other asset at a specific price and at a specific time period. In other words, you buy the right to put in or to sell an asset. When you buy a put, you profit when the asset decreases in value. So you can see the dynamic between the call and the put. The call is you believe that the stock will go up in value, so you buy a call, and you buy a put when you believe the asset will decrease in value. I hope so far you kind of understand where we're going with this. Let's review before we close this lesson. First, options. Option is a contract that gives the buyer the right, not the obligation, to buy or sell 100 shares of an asset. Every option contract carries 100 shares. For that right, you pay something called premium. The premium is the fee that the buyer pays the seller to buy that call. And that premium, that fee that the buyer paid the seller for that contract, we call that a premium. Then we have strike price. The strike price is the contract price that we agreed on. The contract has a set price called strike price where the buyer and seller agree to either buy or sell the asset. You cannot have a option contract without a strike price because we have to agree on what price that you will buy the asset. The contract also has a set expiration when the contract will expire. Also, that has to be agreed on before the contract is passed on or sold to. A call option is an agreement that gives an investor the right but not the obligation to buy the asset. And a put option is an agreement that gives the investor the right but not the obligation to sell an asset. You buy a call when you believe the price of the stock will rise, and then you make money when the stock rises. And you buy a put when you believe that the stock will decrease in value, and you make money when the stock decreases in value. On our next lesson, we'll be talking about why trading option. We will show you all the benefit of trading options as well as the disadvantage of trading options. And then you will realize why you might need to trade options. Now, if you like this lesson and want to see more like it, please subscribe, comment, like, and share. Thank you.